One of the things that I've learned in this business is you have to know who to listen to. And when Brian Reynolds talks, I listen. Brian Reynolds has done a tremendous amount of work on credit and how it impacts the stock market. And so one of the things that he is focused on is what we call the shadow banking system. So think of underfunded pension plans and insurance companies who seem to have an insatiable appetite for corporate debt. So they've been big buyers of corporate debt. We've had record issuances. And what have companies done with that debt? For the most part, they've invested in CapEx, but more than that, they've invested in share buybacks. And share buybacks are one of those things that get the ire up of many in Congress and the Senate. But effectively, what a share buyback does is it reduces the number of shares outstanding, and that raises the earnings per share. And that's why stock prices tend to go up post share buybacks. But one of the other things that Brian has focused on is valuation. You're hearing a lot on the financial news network say that stocks are overvalued. They'll cite a PE of 27. Some will cite a PE of 24. But what really matters is the relationship between stock prices, or the earnings yield on stock prices on stocks, and junk bonds. And I'm going to cheat because I'm not nearly as smart as Brian. But what he's focused on is the earnings yield on stocks is 3.7%. That's half of the yield on junk bonds. Why is that important? It's because junk is the currency that financiers can convert equity into debt. And this relationship is right in the middle, as you can see from the chart, of past measures where investors can profitably buy companies using debt. And the determining variable seems to be credit flows. So if you look at that chart on the right that he has prepared, and we're borrowing with his permission, you can see that there are times when stocks have been extraordinarily expensive, and then as in 2021, and then where they are now, which is kind of middle of the road, not certainly not cheap, but not expensive. I would point out also that in 2021, going into 2020, actually, we thought stocks were, by our metrics, we thought they were very expensive. And so we bought puts on the SPY just to provide some protection for our clients, which worked out very nicely. We didn't know about the COVID bear market, but it worked for us nonetheless. So just an important metric to keep in mind when you worry about or think about whether or not stocks are too expensive because they've run up so dramatically. And then I'm just going to jump in, and Arthur, you weigh in on technicals. I don't know if you want to, but if you just look at, I don't either, but it's an important metric. If you just look at the number of stocks that are trading above their 200-day moving average, you'll see that it's above 70%. And that's the range that you need for a bull market to continue. Between 60 and 85% is where we've been all year long. But you really want to see a greater than 70% number of stocks that are trading above their 200-day moving averages. And indeed, that is where we are.
And remind everybody that stocks should be forward-looking.
Yes.
So you should be looking out the windshield of the car, not in the mirror.
No, that's what the Fed does. They drive through the rearview mirror. We don't want to do that.
I say they drive through the windshield, but unfortunately they're going backwards.